Welcome back to Alpha Recap. I'm glad you're here. We closed a pretty eventful market day and week, so we're unpacking the headlines, the surprises, and the tech threads that matter. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Excited to dig in. Lots to cover from oil to AI hardware.
All right, quick snapshot to set the stage. Markets closed the week under pressure after oil jumped, Treasury yields moved higher, and diplomatic headlines disappointed. That combo wiped out earlier gains and really reintroduced volatility across the board.
Yeah, so what really stands out here is the convergence. Geopolitical risk and energy, policy repricing and rates, and then pockets of idiosyncratic strength in tech. It felt like a classic risk-off day with a few exceptions.
Let's start with oil. What happened there and why did it matter?
Oil jumped after renewed concerns around the Strait of Hormuz and constrained flows out of the Middle East. That pushed energy-linked assets up, and importantly, it fed into a broader risk-off trade in stocks and sovereign bonds. When the oil price moves because of choke point risk, it changes the discussion from a short-lived premium to a potential supply reallocation.
So energy helps, but bonds didn't help as a hedge today. Yields moved higher, correct?
Right. The bond market was repricing to reflect a potentially tighter policy path under the incoming Fed chair, Kevin Warsh. Traders pushed yields up, which in turn puts pressure on equity multiples because future profits are discounted more heavily when rates rise. I mean, when you step back and look at this, that dynamic was a big part of the sell-off.
And then on top of that, we had company-level stories. Give us the quick hits on equities.
Sure. Growth-sensitive names took the brunt of it. Breadth was weak across major indexes. But there were exceptions. Cisco beat on earnings and outperformed, and Nvidia actually rose, up about 4.4% on heavy volume, showing how a single-name catalyst can override the macro headwind intraday.
Wait, say that again? Nvidia finished the day up?
Yeah, up about 4.4% and trading around $235.74. Heavy turnover too. That was one of those idiosyncratic moves that stands out in a down day.
And outside the mega names, we saw activist flows and other corporate updates, right?
Exactly. There was a notable activist reshuffle. Starboard closed a stake in Salesforce and opened a position in CarMax. That kind of rotation changes liquidity dynamics in those names. Also, ASI updated revenue guidance tied to a treatment called Leqembi, projecting about 143.5 billion yen for fiscal year 2026, a detail that moves some biotech and partner stocks.
Let's pause on that for a second. Starboard moving out of one software name and into a used car retailer feels like a major sector signal.
Yeah, that tracks. It's a vote of confidence toward asset-heavy, cash flow-oriented businesses at a time when yields are higher and growth multiples are under pressure.
Okay, big topic change. The photonics and AI hardware angle. This is where the note we read got pretty technical. Break it down for listeners.
Happy to. In simple terms, hyperscalers are packing GPUs into extremely dense racks for AI training. Those racks consume enormous power and need a lot more data moving in and out of each chip. Bandwidth that traditional metal traces and copper are starting to hit physical limits on, both for speed and heat.
So copper's hitting a wall. Then what?
The technical fix is to move from electrical connections to optical connections, basically tiny light-based links at the chip or wafer level. Think of them as short light highways that carry more data with less heat and lower latency. Analysts call this photonic interconnects, photonic interposers, or co-packaged optics.
Got it. And that leads us to the private funding detail. Poet took a round, right?
Yes. Poet raised $400 million at a premium. That was flagged as significant because it's capital specifically into wafer-scale photonic integration. In other words, investors are backing the companies trying to scale this optical approach into manufacturable products.
Why does that matter for the broader market and for AI compute economics?
If these photonic interconnects scale successfully, they can lower system-level constraints on how dense AI clusters can be, cut power per flops, and reduce rack-level latency. In plain English, faster training, potentially lower data center capital expense per unit of compute, and a reshaping of procurement patterns for hyperscalers and cloud providers. But if the transition is delayed, GPUs still face diminishing returns mixed with higher integration costs.
That's a big structural story. So we have short-term macro forces pushing down broad markets and a medium-term tech structural story pulling capital into specific solutions.
Right. It's a bifurcated market. Short term, oil and rates are dominating headlines. Medium term, secular AI investment and photonics are real forces, backed by meaningful private capital.
Let's touch on some of the hard numbers mentioned in the reports. Keep it conversational.
Sure. Consumer internet names have been under pressure, down about 16.6% over the last 6 months. PNC Financial was trading near $213.57, which sits below a consensus analyst target of about $243.11, roughly a 14% gap. And there were intraday index slides in the neighborhood of about 8 to 9/10%, with some notes highlighting dispersion moving more than 2% in other metrics, so higher intraday volatility overall.
And specific corporate headlines aside from the tech funding?
Corby Spirit and Wine reported non-GAAP earnings per share of 28 Canadian cents and revenue around 58.3 million Canadian dollars. These were more headline updates than forward guidance, but they still matter for sector-level sentiment.
Okay, conflicting narratives. What were analysts debating today?
There were 3 big debates. 1. Will macro tightening and higher yields dominate near-term and compress tech multiples? 2. Is the oil move a temporary supply shock or a structural demand shift, maybe because of rerouting of Chinese purchases toward US barrels? And 3. With both stocks and bonds selling off, are standard hedges broken? And where do you rotate? Duration, real assets, or idiosyncratic names like AI hardware?
Tough call. It really depends on horizon and risk tolerance, right?
Exactly. Short-term traders should expect higher dispersion and event risk. Longer-term holders of growth should be thinking about discount rate sensitivity and stress testing multiples. Income investors need to reevaluate duration exposure given the repricing. And value or energy-focused strategies might see tailwinds if higher oil persists.
Let's do a quick segment of super short reactions. Rapid fire. Ready?
Ready.
Oil spike. Transitory or structural?
Could be structural if China shifts purchases. Watch shipping and trade flows.
Photonics. Hype or real capex shift?
Real, but it's a multi-year manufacturability story.
Bonds and stocks both down. Portfolio hedges broken?
Possible. Recheck correlation assumptions and run stress tests.
Nice. Back to the analysis. Any concrete watch points for next week?
Yes. First, Treasury yields and any Fed commentary under Kevin Warsh will be market moving. Second, oil price direction and diplomatic updates around the Strait of Hormuz. If disruption persists, that reinforces the energy rotation. Third, earnings cadence. Cisco and NVIDIA showed that company-specific beats can matter even in a tough macro. And finally, watch for photonics commercialization milestones or further capital raises that prove manufacturability.
And how should different investor types think about all this in practical terms?
Short-term traders should size positions for higher volatility and be ready for big intraday moves. Long-term growth holders should stress test rate scenarios and monitor which companies are actually benefiting from AI infrastructure spend. Income investors need to reassess duration and consider yield shock modeling. Value and energy-oriented investors should track whether the oil move persists beyond a short-term risk premium. Event-driven investors should follow activist moves like the starboard rotation. Those create catalyst windows.
And a reminder, everything we discuss is informational, not advice. We're not telling anyone to buy, sell, or hold anything.
Right. Analysts note these are perspectives and data points to inform your own research, not personalized investment advice.
Almost done here. Final quick takeaways. Give listeners the top 3 things to remember.
Okay, 1. Headline macro. Oil and yields reasserted themselves and drove broad volatility this week. 2. Structural tech momentum, specifically AI, infrastructure, and photonics, continues to attract capital and can create outsized single-name moves. 3. With both stocks and bonds under pressure, recheck hedges, run stress tests, and focus on idiosyncratic opportunities if your time horizon and risk tolerance allow.
Great summary. Honestly, I was a bit surprised by how fast a single name like NVIDIA could buck the trend today. But the photonics funding helps explain why investors are still looking for winners.
Yeah, absolutely. And to add to that, keep an eye on measurable commercialization milestones for photonics. That's when the story moves from promising to economically impactful.
Okay, wrapping up. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for joining us. Stay curious, and we'll dig into the next set of headlines together.
Thanks for listening to Alpha Recap. See you next time.